Hello, everybody. This is PC here from Global Alpha Search. It's the 1st of February today, so I owe you a monthly portfolio update, and I'm here to present it for you. So we had a great January. I wanted to start out with that. The portfolio is up over 2% with minimal volatility. Our average risk score was 2. During the month, there were moments where we had a risk score of 1, 3, and 4, but on average it was 2. So contained the volatility. The drawdowns on the portfolio were minimal, and especially given the volatility in the equities markets, I'm very happy with the performance of our portfolio and how we did throughout January. So let me just skip to the presentation for you quickly. Just one second. Yes, so starting out, it was a great month, and I'm really happy because of that. By the way, we had a plus 40% January copiers count in January, and I'd like to thank you all for joining the Global Alpha Search portfolio. I will be trying to do my best going forward, obviously, to both keep the performance in the green every single month, or at least in as many months as possible, but definitely throughout of the years that are ahead of us. And on the other side, I still plan to, first of all, protect the capital and minimize the drawdowns. That's you may know from my bio and from my feed. This is our one of our major targets, which is positive long-term returns with minimal drawdowns. Let's just kick off with the presentation quickly. Our synthetic internal benchmark, which is currently calculated of 50% S&P, 20% gold, and 30% treasuries, which are the weights typical for the boom phase of the economic cycle, which started in January 2022. The synthetic benchmark is down 4.2%. Our portfolio, which is the Global Alpha Search portfolio, is up 2.1%. So we effectively outperformed the synthetic internal benchmark by over by exactly 6 percentage points, and I'm really happy with that. We even outperformed the equity indices by more than that. As you see here, the S&P 500 was down over 5% for the month, and the Nasdaq 100 was down 8.5% in January 2020. So our outperformance versus the major equity index, which is the S&P, was 7.4 percentage points. Very good results, and going forward, I plan to basically hedge the portfolio into the volatilities I'm still expecting in 2022 to minimize the drawdowns. As of the end of the month, our equity allocation looked like this. Pure stock allocation was slightly less than 43%. With ETFs, it was slightly less than 45%. Obviously, fully hedged, as I have been presenting on my feed throughout January, with basically a little tilt to the downside to basically take advantage of the downside volatility that we've been facing in January. Exposure in the portfolio at the end of the month was 49% stocks, long stocks, ex the uranium miners exposure through URA, but that's a small one only, so it does not really make much of a difference in the aggregate view on the portfolio. Short indices for hedging was slightly less than 38%. Long treasuries 4.5%. I have basically decreased the exposure in treasuries throughout January into on expectations of rising long-term yields. So I wanted to be less exposed to the long-term US Treasury market, basically. Still long gold, directly in the gold bullion, long by 5% of the portfolio, and in uranium miners, 2% of the portfolio. So we basically have an aggregate 7% into commodities right now, exposed in the Global Alpha Search portfolio. We still have a little bit of crypto, but as you know, crypto is just basically a side asset in our portfolio, and will most possibly never be more than 5% in the portfolio on aggregate basis. Risk Average risk, as I have already mentioned, 2, and maximum risk was 5, but average was 2. So I'm very, very happy with the relation between the return that we have managed to achieve in January versus the drawdowns and the downside risk, first of all, that we have been facing, which was fully minimized throughout the month. Major reshuffles that I have done in January looked as follows. We decreased overall allocation to stocks from 70-75% to 45-50%. That's in line with the cycle phase change that we have experienced on the break of the year. December was still part of expansion phase according to our macro model that we use, which is the enhanced aggregate spread by Dr. Robert Daly. But in January, as of the model's readings, we're already in the boom phase. So on aggregate basis, we want to have less exposure to equities. Decreased aggregate exposure to growth stocks. I have decreased Alibaba with a loss and Facebook with a profit, and some others as well, but generally decreased aggregate exposure to growth, and we increase exposure to value quite substantially, as I think, given the circumstances that we're facing, which is high inflation and growing interest rates, we will see the year of value, let's say, in 2022. Increased exposure to financials, also to take a chance on the rising interest rates. So we've bought into Morgan Stanley and JP Morgan a little bit, and some more value stocks like Coca-Cola, and a bunch of EU stocks, which are currently a relatively substantial part of the portfolio. We have a bit higher exposure into gold right now versus yet December last year, and most possibly the exposure to gold, dependent on the circumstances, will be either at the current level or higher in 2022. We've also built up a quite nice cash buffer to use it for hedging and buying the dips, as I think there will be plenty of opportunities in 2020. Major reasons for our performance were equity exposure hedging. So we took good care of the portfolio's long equity exposure by hedging with short indices. Overall exposure tilted to the downside, portfolio reshuffle into value, that helped a lot quite as well, and a little bit higher exposure to gold. Downside risk was minimized, as I have already mentioned, and portfolio protection is the main target. That's pretty much it in general. Let's just go further into details. Major market drivers in January, in my opinion, were a couple. First, equities sell-off due to the Fed policy readjustments. Basically, what we found out in January, throughout December and at the start of January, was that the tapering is going to be faster than previously expected. There's going to be more rate increases in 2022. Right now, we're talking about 4, some even talk about 5 increases in 2022 already. And the balance sheet runoff, which was announced by Chair Powell in December, but it's actually meant to take place in 2022 from what it looks, and the Fed seems to be quite serious about it, and I think it's basically one of the biggest headwinds for the equities this year. Not really the interest rate increases themselves, but the balance sheet runoff that the Fed is seriously considering right now. Volatility outbreak, as you saw, volatility was massive. Some of the growth stocks were absolutely hammered down between 60 to 80%. Treasury yield spiked from like 1.4, 1.5 back to almost 1.9 at the heights in January, and I think there's basically more to come as far as the rising yields is concerned, because the Fed seriously needs to start fighting inflation, and to do that without really making the yield curve invert, they will have to buy less long-term treasuries, and this will in general mean much lower demand for long-term treasuries. Read higher interest rates and higher long-term interest rates. Fears of whether the Fed manages the policy ahead without causing recession. Obviously, that's what I have just mentioned, basically, because the biggest deal for Chair Powell right now is going to be to increase long-term interest rates without really causing the yield curve to invert. Right? This is absolutely crucial. Grimmer outlook for 2022. So we have some downgrades of the macro growth already from a couple of big houses. We're expecting a bit slower growth, higher inflation, maybe even stagflation. The dispute about the potential stagflation situation is already underway, and I'm hearing more and more comments from different analysts into that respect. Let's just take a quick look at the tapering and how it's going. Here in the left upper corner, you see the current Fed's balance sheet. We're still almost at $8.9 trillion, but as you see here in this chart, these are the expectations of Wells Fargo. The balance sheet is expected to flatten throughout the first half of 2022, and somewhere in the second half of 2022, it's going to start to fall, actually. So these are going to be very, very important and interesting months for equities, and we'll see how equity markets are going to stand this. One other very interesting point here, as you see on this chart, this is the ratio between the CPI, current CPI, and the 10-year Treasury yield. It's a long-term chart, courtesy of No Spin Forecast and Dr. Robert Daly, dating back to 1955, actually, so a very, very long time. And as you see here, we have not yet ever faced a situation where the Fed and governments have been monetizing the fiscal debt so aggressively as they do now. The ratio has never been higher than 2 throughout all of those years, and right now the ratio is almost 5. So we are in an unprecedented situation, really, and I think this only shows how serious the situation is for the Fed to manage the situation properly, not to risk basically driving the economy into recession. A quick look at inflation. All the data that are highlighted in yellow are readings that are higher right now than a month ago. So as you see here, out of like what 2, 4, 6, 8, 10, 12, 14, 16 major inflation readings, vast majority of them are high and higher than a month ago. So the tendency in general for the inflation is still to be speeding up, and I think there is yet a little bit of ahead of the tendency before the inflation measures really kind of ease a little bit. And just pay attention to this one here. The Michigan 5-year inflation expectations are 3.1. This is way higher than the Fed would want it to be, and it's higher than previous as well. So I think this shows the risk of the inflation expectations basically grinding higher and staying higher for a longer period of time. It's a big risk for the Fed, and they would definitely not want that to happen. Let's just move on. That's the macro, worldwide macro heat map. Just a quick look. Inflation is still a big issue in 1, 2, 3, 4, 5, 6, 7, 8 major economies out of 10. So definitely biggest issue is inflation. Then I would say the second biggest issue is basically the government fiscal deficits that we're seeing rising massively right now, obviously due to what we have been facing throughout COVID, etc., etc. Inflation is spinning out of control in many areas. Central banks are in trap, massively growing pressure to act, but fiscal debt servicing costs are huge. And basically, I think this is the biggest problem that the Fed and other central bankers are facing right now, how to manage the interest rate increasing without really causing that crisis like we saw, for instance, in 2011 in Greece and other Southern European countries. The QEs, yeah, that's basically what I have just said, right? So how will the CBs manage the shape of the yield curves on the long tail, not to induce big flattening? It's a big issue, and I think we all need to think of that in 2022 as from what I see, and most of the market commentators see, the Fed is getting more and more determined to act. I have not personally seen Mr. Powell so hawkish ever in my life yet during the last presentation that he had after the FOMC meeting. Now, evaluations. With a drop in the equities, obviously the valuations are coming off finally of pretty frothy levels, as you see here. For the large cap space, they have fallen from like 20, 22, 23 to slightly below 20. So a good tendency in the small cap space, so the Russell 2000 space, the fall has been even more dramatic. The forward PEs right now for Russell 2000 are, let's say, at 23, 24, and as you see here, the growth space in the Russell 2000 has been falling quite massively as far as the forward PEs are concerned, from around 60 down to 40 right now, but these are still frothy levels. So I would be expecting this ratio between small cap growth and value space to be narrowing throughout 2022 going forward. The PEG ratio, so the PE to growth ratio, this is pretty interesting. There has been 1, 2, 3, and we're in the fourth circumstance right now over the last 15 years where the PEG ratio for the S&P 500 was actually at 1 or below. So this shows that, you know, basically in the long run, the corporations are still showing good growth, and there's going to be plenty of good buying opportunities in 2020, I think. Just keep that in mind. And also some statistics here. All of those circumstances faced either a big correction, 2021 or 2021 correction in 2018 and 11. Obviously, we had the recession in 2008, which was the great financial crisis. So the equity indices did not even had a correction back then, but they had a massive bear market, down like 40%, 60% even so for some of the indices. Right now, the correction ended at minus 11% for the S&P. I think there's more to come, basically. So you know, stay agile and remember that in the longer run, the PEs relative to the growth ratio for many companies are getting very, very good for good cheap buying opportunities, basically, to come ahead. Growth versus value for the S&P, that's how we look right now. Growth is still above 25 times PE on a forward basis, and value is slightly above 15%. So the spread is still high. I think it will be narrowing out. I think we want to stay long value versus growth on a relative basis this year, and that's the plan for my portfolio, basically. Yeah, that's just a ratio here between growth and value put together by Citigroup. And as you see here, on a PEG basis, value is almost 25% cheaper than growth right now. So this only kind of underlines the reasoning behind what I have just said, to stay long value versus growth on a relative basis. Macro phase forecast, we're in the boom phase. I've already mentioned that. That's what our macro model is telling us, and we want to basically stick our investment policies with what we usually should do during the boom phase. So we're looking for signs of instability and unsustainability in the macro readings, basically in payrolls, industrial production, and the delta. So the difference between the year-on-year change in the S&P 500 and the CPI. More on that, obviously, in my feed. You can read about how we read the model, the enhanced aggregate model, and how we use it into our investing philosophy, basically by readjusting the highest risk assets allocation, which is the equities. Much more hawkish and aggressive Fed rhetoric expected, we've already discussed that higher rates, lower systemic liquidity, and higher volatilities. That's what I think is still ahead of us in 2020. And first of all, the Fed put, which the market has been addicted to for over a decade, is basically hardly in place right now. And obviously the market will, I think, come to a moment again sometime this year when it will test the Fed's plans as far as the balance sheet runoff is concerned. So I think there's definitely more downside volatility this year. We need to stay agile, and we need to be using the opportunities. That will be plenty this year, I think. Yes, avoiding increased leverage, avoiding crowded trades in the growth areas. That's the plan. Diversifying into more value stocks and into asset classes which have zero or negative correlation to stocks, which is basically long-term treasuries, gold, and obviously cash. Keep an appropriate cash buffer. That's very important. As of now, the cash buffer is between 20 to 30%. It will be used for hedging and buying the dips in some of the good companies. I think we will see more bumps this year. Just a general view of mine. Generally, I stay constructive on equities, but I think the volatility will be higher. My end of year target is 4,900 to 5,000 still, dependent on the EPS expectations from the market consensus. It might, I think, be tilted to the downside, but I will be doing a review of this at the end of the quarter. Maybe I will come back with a new official end of year target to you then. I think we will see good buying opportunities in Trier. I have already mentioned that there will be some corrections, and I think they are inevitable given the Fed plans about raising rates and decreasing balance sheet. We're in the boom phase, so naturally some flexibility, some cautiousness is basically advised. And the very major target, obviously, as usual, to provide stable returns for my copiers. Again, thank you all for copying me so far, and for all the prospective copiers. I still think I will pledge to be bringing highest quality investing and obviously presenting what I do in my weekly, sometimes monthly updates, and basically as the time runs and things happen directly on my feed as well. So thank you very much for today. If you consider me, please use $500 as a minimum. That's what I suggest. Obviously, we can start with less as well, but to copy the portfolio more precisely, I think $500 is advisable. Always click copy open trades, and always please do remember that we do invest here, not speculate. So I strongly suggest that you copy me for at least 1 year to basically guarantee your expected returns. And please be patient and resilient through turbulences. We've already had a bunch of them in January, and I think there is more to come this year. Thank you very much. Have a great February, guys, and I'll be back to you with another video in a month. Thank you.